What's up, guys? This is your channel host MD catching up with you. As I promised earlier, I had managed to make a video on technical and structural correction, which any trader or investor should know. So, without any ado, into the video. In this video, I will try to explain you about the structural and the technical corrections with example, the effect it has on business, economy, stock, and the market itself, and how big a game changer it would be if you were able to spot it at the very beginning of the cycle itself. Structural correction is the price adjustment to a stock either on the upside or on the downside. Structural correction happens when there is a structural or a fundamental change, when the existing business model migrates to a new model of conducting a business, manufacturing, or a service delivery. This could happen when there is a new technology, a product innovation, or a discovery of an entirely new business model. What structural change brings in is that it makes the existing technology obsolete. It brings in technological disruption, and it forces the existing business to either shut or to re-engineer itself in order to survive in the market. A structural change happened on the advent of mobile phone, when the very way of communication changed upside down. The use or the dependence on the landline drastically reduced. It actually disrupted that industry, but what it created was a new way of providing network and the infrastructure support for that new network operator. Moving on to technical correction. A technical correction happens when the market is either oversold or overbought. So the market, not to adjust this price action, it tends to move towards the mean, which is also known as the mean reversion. Typically, a trader gets very excited when their trading desk indicators like the RSI, which is the relative strength index, or the moving average convergence or divergence, or of a fact the Bollinger Band indicates or alarms him that there is a technical correction in the market and it's the right time for you to either enter or to exit the trade. So generally what happens is that if the market is overbought, so the correction will be on the downside, so people start selling it. And if the market is oversold, the indicators will start popping up signals to buy, so people buy into the market and the market rises and the mean reversion happens. So that's all about the fundamental concepts of the structural and a technical correction. The need to this topic is that to spot the correction before the correction actually happens, you have to be ahead of the curve. Generally, this structural correction happens over a period of time. So if you're able to spot the curve, you can make a big fortune out of that. Spotting of a technical correction will give you a wonderful opportunity to buy a stock at a relatively cheap price, as a stock game is all about buying low and selling high. And on the other hand, it gives you a better chance to exit an investment when there is time and when you're sitting on profit. That's it, guys. That's for the video. I hope the video was useful. I'll try to catch you on another day on another video. Until then, it's me, your channel host MD, signing off. And remember to subscribe to Good Thoughts, like what you do, and share positivity. Bye bye.